Yo, what's good? My name's Kang the Kangaroo, and in this video, I'm going to be telling you how you could potentially pay $0 in capital gains tax as someone who's in the US working on a temporary visa. But first, let's do a quick refresher on capital gains and taxes. So whenever you buy a stock or an ETF or any other type of asset, the cost at which you acquire that asset is called the cost basis. Now, this cost basis is later used to determine how much profit or how much loss you have made on the sale of that asset, and therefore how much you have to pay in taxes or how much you can deduct from your taxes. So let's say, for example, you bought a stock for $100 and now it's worth $200 and you decide to sell it. Now, when you sell it, you have made a gain of $100 and now you're gonna have to pay tax on that money that you've earned. And the same is opposite for losses. So say you had $100 and now it's worth $50 and you end up selling that stock. In this scenario, you've done a capital loss of $50 and you can use it to deduct against your taxes. Now, the capital gains tax actually only applies when you sell the stock or the ETF that you've purchased. So if you just buy it and let it grow over time and the value increases, this is actually called an unrealized gain. And if the value decreases, this is called an unrealized loss. So after this quick refresher, we can understand how capital gains tax works at a very basic level. And now we can move forward on how you can actually pay none of this capital gains tax if you are working in the US under a visa. All of these things kind of tie in together under two major points. Point number one is that you are a Canadian or you are someone else that is working in the US on a temporary visa. And number two is that you are investing into your brokerage accounts. So number one, let's say that you're on a TN visa or an H-1B visa working in the US. When you decide to leave the States, you do not have to pay an exit tax on all of your assets. So normally, if you're a US citizen, you are taxed on all of your worldwide income. Now, the only way to get around this is to renounce your citizenship and give it up. But by doing so, you have to pay what's called an exit tax. So what would happen in this scenario when someone decides to give up their US citizenship is that they're going to take a look at all of their assets and do what's called a deemed disposition and sell all their assets on the day that they leave the US. Now, this sell isn't actually, going in and selling it into your brokerage accounts. It's just doing an on paper sell and then seeing what the value or seeing what the capital gains would have been if you had done that actual sale. So after this sale is done on paper, you're going to have to pay your exit tax, and then they're going to adjust your cost basis to what it is on the fair market value of the day that you're leaving the US. Now, from what I understand about US taxes and what I've been reading online, not a lot of people do this because it is pretty expensive to do this kind of process to pay an exit tax on all of your assets on your net worth, essentially. And in reality, it's a lot more complicated than what I've laid out. There's a lot more ifs, ands, and buts. So I would definitely go out and seek professional help on this for sure. Now, this exit tax also applies for green card holders as well, but I'm going to touch on that a little bit later in the video. But as someone on a TN visa or someone that's on an H-1B visa, you do not have to pay this exit tax when you leave the US. Now, this information is great. You don't have to pay this exit tax after working in the US for however many years, but you're still carrying around this very large unrealized gain in your brokerage account. But recently, I was doing what personal finance nerds do, and I was looking at personal finance stuff online, and I came across this. So this is a guide for people that are immigrating into Canada, and this is what they have to say about bringing assets back into the country or into the country. If you own certain property at the time which you immigrated to Canada, the CRA considers you to have sold the property and immediately reacquired it at the cost equal to the fair market value on the date that you became a resident of Canada. This is a deemed disposition. Now, this property can include items such as shares, which is stock shares, ETF shares, jewelries, paintings, or a collection. Usually, the fair market value is the highest dollar value that you can get for your property in a normal business transaction. You should keep a record of your fair market value of your property on the date when you arrive in Canada. The fair market value will be your cost when you calculate your gain or loss from disposing of the property in the future. You dispose of the property when you, for example, sell it, give it away, it is destroyed or stolen or whatever like that. So to put this in much simpler terms, when you move back to Canada or when you immigrate to Canada, they're going to look at all of your assets and then create a new cost basis on the day that you enter Canada and that you're immigrating to Canada. So as a very simple example, you worked in the US and you bought a stock for $100 and now it's worth $150. You have an unrealized gain of $50. So when you move back to Canada and you bring back your stocks with you, the CRA will ignore the $100 that you initially bought it at and say, okay, from now on forward in Canada, the value that you bought the stock at is at $150, essentially erasing the $50 in capital gains that you have acquired. Now, what this means is you've essentially adjusted your cost basis completely for free without having to pay any capital gains tax. Now, if you scale up this scenario to the hundreds of thousands of dollars or millions of dollars, you can see how insane of a life hack this is. Which brings me to my second point why all of this kind of ties in together, which is the brokerage account. So normally in financial planning, the brokerage account is kind of looked at like, the last thing that you should look at, the last thing you should worry about because it's not tax advantage in any sort of way. But in this particular scenario where you're a TN visa holder or an H-1B holder, the Brokerage account kind of acts like a TFSA or a Roth IRA light version, meaning you can contribute after tax dollars and let it grow until you eventually move back to Canada, where you can adjust the cost basis and not pay any capital gains tax on the amount that it has grown while it was in the US. Now, the reason that I say light version is that while you're in the US, you're still on the hook for taxable events that happen in your brokerage account. So saying you're buying stuff and then you're selling it, that's still a taxable event. You're not sheltered from that amount of tax. But say, for example, you bought something and then never touched it and never sold it until you move back to Canada. In that scenario, you've not done any taxable actions inside of your brokerage account, and the cost basis will be adjusted when you go back to Canada. Another reason that I'm saying it's a light version is that once you're back in Canada, any taxable events that you do in your brokerage account again, now this is also going to be a taxable event, but at your adjusted cost basis. But I just want to reiterate the fact that you can even contribute and then let it grow and then adjust your cost basis later when you move back to Canada is just insane to me. And when I first read this, I could not believe it. I was like, this is like the biggest hack that I've ever seen in my whole entire life. This is loophole. There's no way this could be true, because for me, it seems like it's way too good to be true. But after doing some more research, reading some posts on Reddit, commenting on posts on Reddit, it seems like this is a pretty common thing. And Canada is very welcoming to people who are coming back and immigrating back into Canada. Well, with that being said, I'm obviously not a tax expert, not an immigration expert, and there are some caveats and some things that I've ran into when doing my research that I just want to bring up right now. So first and foremost, this is some pretty complicated stuff. Like on one hand, you have immigration, which is definitely very complicated. On the other hand, you have taxes, which is also very complicated. So both these things are pretty complicated by themselves, but combining them, it's like you're facing the final boss of bureaucracy. Like, it's definitely a process that I would personally have a lawyer look through and get involved with, and that's what I would recommend to anyone that is thinking about doing something like this. Another thing that I want to note is that if you're early on in your career and you think that this would be helpful for you to kind of plan your financial future, you should think about this stuff and then talk to a lawyer or talk to an accountant right now while you're early in your career, so you can make those kinds of optimizations. Because for me, I think this kind of changes the way that I look about financial planning for the future, especially with the thought in mind of how I can adjust my cost basis if and when I move back to Canada. Now, when I was also reading this guide of Canadians immigrating back to Canada, I thought that this was only going to be for new immigrants that are coming to Canada, not Canadian residents who ceased being a tax resident and then came back later on in their life. But I found this part in the guide where it says, you become a resident of Canada for income tax purposes when you establish significant residential ties in Canada. You can usually establish these ties on the date that you arrive in Canada. And then it lists the residential ties. It says, a home in Canada, a spouse or common law partner who has moved to Canada to live with you, personal property such as car, furniture, or social ties in Canada. Now, other residential ties that may be relevant to determine your residency status include, but are not limited to, a Canadian driver's license, Canadian bank accounts, or credit cards, or health insurance with a Canadian province or territory. And there's some other stuff that I don't think is really important to what we're talking about right now. And then it says at the very bottom, if you are a resident of Canada in a previous year and now you are a non-resident, you will be considered a resident of Canada for income tax purposes when you move back to Canada and reestablish your residential ties, which I think covers the scenario where you're a Canadian, you've left Canada for tax purposes, and now you're re-entering Canada as tax purposes and re-immigrating with new assets. But this kind of leads me to another point that I want to bring up about properly exiting Canada and properly severing ties and becoming a non-tax resident of Canada. So it specifically says if you are a non-resident, which in my mind means you have to file your taxes properly in the year that you leave Canada. So in my personal situation, I had to do an exit tax when I left Canada to work in the States, and I had to pay like $6,000 or $7,000 in Canadian. I can't remember exactly. By doing so, I became a non-resident for tax purposes in Canada. So now, if and when I come back to Canada, it's pretty clear that I was not a tax resident of Canada because I clearly paid my deemed disposition and my exit tax, and now I'm re-immigrating. So in my case, I think everything would be fine and I'd be able to do this. But if you didn't file your taxes properly when you left Canada and you didn't do a deemed disposition, I don't know if the case would be exactly the same for you. Now, again, this is complete speculation. I'm not a tax person whatsoever, but in my mind, I think the CRA could make the argument that this whole entire time that you were in the US, you were still a tax resident of Canada because you didn't file your taxes properly when you left, and they could claw back some of those gains that you had bringing into Canada. But again, I'm not really sure about this. I would have to do a little bit more research and probably talk to an accountant about this. So if you have any information on this, or you're going to talk to an accountant anytime soon, ask them this question and please let me know because I'm very curious. Now, also on this page is something called unwinding your deemed disposition. So when I left Canada, like I said, I had to pay the deemed disposition, but from what I'm understanding, when I come back to Canada, they can actually unwind some of this money that I've paid in taxes to reduce my tax bill for the year that I immigrate back to Canada. Now, again, this is definitely above my pay grade, and I would be 100% talking to an accountant in order to figure this out properly, but it's just something very interesting and something important in my opinion to keep note of. Now, in this video, I spoke specifically about, US moving back to Canada and that type of scenario, because that is what I'm familiar with. But I'm pretty confident that there's other scenarios that you could probably take advantage of that are similar to this. Now, I have a video going over a blind post where someone kind of did something similar to this by moving to the UK for a bit and then moving back to the US to readjust their cost basis. So if this is something you're interested in, I'll leave it up here. And just as a quick note, if you think that you can move to the US from Canada, stack a bunch of money, move back to Canada to erase that cost basis, and then move back to the US again, it doesn't work like that, because on the Canadian side, you're gonna have to pay a deemed disposition because you are a Canadian. So there's no free lunch there in that circumstance. And the last note that I wanna make is about the green card. So earlier in this video, I said that you have to pay an exit tax when you renounce your citizenship or you renounce your green card. But there's a checklist that the US government has posted that determines whether or not you are liable for exit tax as a green card holder. And basically this checklist is figuring out if you're what's called a covered expert or not. Now I'll leave a link on what a covered expert is in the video description because I think it's pretty long. I don't really want to get into it right now. But in order to be a covered expert, you essentially have to be in the US on the green card for at least 8 years. And when I say years, I mean calendar years. So say for example, you got your green card on December 1st, 2024. That year would still be counted as a year. So you would only have until 2024 plus 8 or whatever years left on your green card before you are liable to become a covered expert and then pay taxes. I've seen online is a lot of people will leave after 7 years of getting their green card in order to not pay exit tax. Now, if that sounds kind of complicated to you, it's because it is, right? Like this green card process is the process of becoming a US citizen eventually and becoming a permanent resident, right? So what if instead of getting this green card, you just stayed on a TN visa, kept making money, kept investing, and then eventually moved back to Canada or moved back to whatever, and then adjusted your cost basis, essentially capturing all of that realized gain for free. And what's great about the TN visa is you can infinitely renew it, and there's no quote unquote time limit on how long you have to stay or how long you can stay before you have to pay that exit tax in the case for the green card holder. And this time limit regarding the exit tax is one of the biggest drawbacks, in my opinion, when it comes to getting the green card. And one of the ones that no one really thinks about when they're first starting out looking at their green card or looking at the process. At least for me, it's not what I thought about. And if you're wondering about the other drawbacks that the green card has, you can watch this video right here where I go over 4 reasons why you should not get your green card.